which is structuring a property deal. And we're going to get to that just in a second. Remember, as it is a Tuesday, you can look forward to Balinoko bringing you the farming podcast later on this evening. I'm quite excited about the topic that she'll be covering later on the show. I've been seeing her posting on her social media platforms as well as, of course, Private Properties social media platforms. So do look forward to that at 8 p.m. And of course, tomorrow evening at the same time, you can catch Esti Clarkson on the First Time Home Buyers Show, where she's always in conversation with people who have walked that first time home buying journey and have gone on to grow their property portfolios from strength to strength. Before we get started with our conversation this evening, remember we are running our competition where you stand a chance of walking away with 500 Rands cash every single evening. It has been rolling over for a few days. It's sitting at 2,000 Rands. And I do hope whoever we're going to be calling out this evening is watching us live and is going to claim that money. I know a lot of you at home, especially on our Facebook page, want that money, and I've been seeing you posting. I think yesterday somebody was even saying that they are cousins, they're twin with the person who had won yesterday. But this evening we're going to see if our lucky winner is watching us live to claim their prize. And if you at home want to stand a chance of walking away with that cash, make sure that you interact with the pinned post on our Facebook page. Well, let's get right into this evening's conversation. I know that the tech gremlins have eaten away at our time. We're looking at structuring a property deal. This is, structuring a property deal 101 for beginners. For me, this is one of my all-time favorite, topics, because if anything, it cuts through just about everything you need to know when it comes to property, because you really do need to understand various layers and various facets when you're structuring a property deal. And sometimes even if, you've got one financier, and that one financier could easily be a financial institution, you still need to understand what the fundamentals are when it comes to a property deal. What do you need to be looking out for? What are some mistakes you need to watch out for? And how can you best even position your value proposition when you're going to be approaching private individuals or company to fund your property ambitions or property deal? And that's exactly what we're going to be looking at this evening. I'm joined by Grant Smee, who's a director at Only Realty Group. Grant, good evening, and thank you so much for joining us this evening.
Hi, Zama. Thanks for having me again.
And then for the viewers at home, I want to find out from you, have you ever had to put together a property deal, and what did that process teach you? I'm going to share later on in the show some of what I've learned when it comes to putting together a property deal, and really one of those things that I still carry with me to date. But I want to find out from you at home, have you put together a property deal? What did you learn? What did you discover along the way as you're putting that deal together? Do you share some of those insights with us down here below? Now, Grant, I think, at a high level, when we're looking at structuring a deal, and I think this is one of those things that can be very fun for, especially the finance guys. I always say to people, I'm not particularly a finance person when it comes to, the fine detail, but I'm very good at understanding, some of the fundamentals. And we always talk about understanding particularly your financial fundamentals. What would you say are some key financial fundamentals when it comes to structuring a property deal, especially for beginners at home?
Yeah, so I think the thing you need to consider when you look at a property deal is really what outcome are you trying to achieve. So if you're looking to flip a property, there's certain things you need to look at. If you're looking to buy and hold a property for the long term or medium term, there's other sort of elements you need to look at. So if you're looking to flip a deal, what is the cost of going into the deal? What's the cost of the money or the finance that you are making use of? And then what's the cost of going out of the deal? So estate agent fees, capital gains tax, or trading income or income tax against that property deal. Then if you're looking to buy and hold, again, it's the cost of buying the property, renovating, and then the cost of holding, levies. And we've had this conversation before. Look at the cost of levies, look at the cost of rates and taxes. And then again, and even potentially the cost of ongoing maintenance and your management fees. And again, the cost of the money to hold that property. So, and ultimately on both instances, we're looking whether you buy and hold or looking to flip a property. It really comes down to the return on investment. How much money are you putting in, and what return are you getting on that money? I know a lot of people, particularly finance guys, like you say, will get into much more complicated and complex calculations and do all these sorts of fancy things. And ultimately, what I have found over the last sort of 17 years it really comes down to return investment. How much money am I putting in? How much money am I getting out? What's that return?
Mm-mm. And I think one of the things with working with finance guys is, and I've spoken about this on the show quite a bit, is they want to look at the granular details. They want to understand what the cost per square meter is, what the return per square meter is. And more often than not, when you're starting out, you're certainly not looking at any property investment or property deal, at sort of that granular level, and even understand sort of every 1,000 rands or every 100 rands that's going into a particular property. Of course, the bigger the property, the bigger the numbers, they'll look at the scale of it. But I think at a beginner level, it's so important to not get swept away with, I think, the excitement of owning a property or the excitement of having a tenant who is making their rent on time, and you thinking, well, I'm collecting this rental, but ultimately not understanding, the full-on costs that come with that property. Because I think we often make that mistakes. I know one of the mistakes that I certainly made early on in my own property investment journey was not factoring in the upfront costs, as you were saying, right? So as much as we talk about, budget for the transfer fees, the attorney fees, if you're going to have any, transfer duty, budget for that. When we then run our numbers and as far as our return on investment, we no longer factor those costs. It's almost as though we forget we made all these payments up front, and we're now only looking at the monthly running costs of the property. You're looking at the bond payments, the levies, if it's in the sectional title community, or if you're paying an HOA, and of course the rates and taxes. But you no longer actually factor in even the cost of that facility, because I think this is also one of those costs that we tend to not factor in when we're looking at a deal that we're running. When we then look at some of the mistakes, because I think that would probably be mistake number one, right? Not looking at the overall costs of going into a deal. And later on, I want us to look at exiting and an exit strategy. I've found I'm not particularly too great on the exit side of a deal. Very great at an entry level and optimizing my returns throughout the journey. But the sell side, haven't quite mastered that side. But we'll deal with that later on the show. When we look at some of the common mistakes, Grant, that you'd see people making, what would you say they are, especially in the context of people who are buying multi-lets? Because I'm seeing a lot of people wanting to, go the multi-let strategy, or house hacking, as some people call it, because they're finding that, look, the returns there are great. That you've spread your risk quite well. What are some common mistakes that you're seeing people making when they're building their property portfolio by buying multi-lets in particular?
Yeah. So, the first one is being the eternal optimist. I think a lot of people go into this space just assuming the best and not making provision for the worst. So not making provision for voids, not making provision for maintenance. Multi-lets or these communes are really, high-wearing properties. You've got a lot more tenants in there than the property was built for. Tenants do, or the amount of tenants does take its toll on the property, and there's not a large allocation for maintenance during the period as well. And then I think the second one, so being the eternal optimist, not catering for hidden costs, I suppose. And the other one then is just looking at the cost of money. Multi-lets are notorious for being difficult to finance. Banks aren't that excited about them. although they really should be. And it's sort of a big trick that the banks have and will continue to miss for whatever reason. Maybe it's just not understanding that space. But they are difficult to finance, and traditionally you'll go into the private finance sector to try and get finance for these. But then you look the gift horse in the mouth, and you don't want to take financing from an investor who's willing to give you something at 12 or 13%, although sometimes these things are returning 20, 25%. So just, you don't want to walk away from a good deal because of the cost of finance. You can always, once the deal's in place and it's working and you can go improve the financials, you can go and get further finance and cheaper finance, but don't look the gift horse in the mouth if there is finance available.
If you're just joining us this evening, I'm in conversation with Smee, who's a director at Only Realty Group. We're looking at structuring your property portfolio. Structuring your property portfolio 101, especially for those who are still relatively new in the property game. I think we'll do a master version, right? A slightly more advanced version of this, because there are different ways to structure a property deal that are very creative and innovative and using a combination of different kinds of finance. I think more often than not, we're very used to using one kind of finance for a property deal, as opposed to using and playing around with different variations. And we'll definitely do an advanced version of this. But this is at a beginner level. If you're looking at structuring a property deal, this is some of what you need to look out for. I want us to go for a quick break and see who the potential winner for this evening's 2,000 Rand cash prize is. And when we come back, Grant, I want us to look at how can viewers at home, position themselves when it comes to raising private capital. Because as you were saying, more often than not, when we're dealing with multi-lets, banks tend to be very reluctant to fund them. And we're increasingly seeing a lot of, up and coming young property entrepreneurs and investors wanting to go into that space and seeing a gap in the various communities that they're operating in or want to penetrate and want to raise capital. And sometimes there are some of us who have the capital to kind of play around with and looking at different deals to go into. On the one hand, how do you structure a deal to make it appetizing for various private backers who may have some funds to put in your deal? And also then on the other side, how can the private backers, because I'm also not taking it that every private backer has expertise, but how can they also best adequately vet the people approaching them for this capital, and for them to also be clear on what their exit strategy and how they're going to make returns on a particular deal. Let's go for that quick break and see who the lucky winner is of the 2,000 Rand that is in the money bag. And this evening's winner for that 2,000 Rands that is in the money bag is Megan Matthews. Megan Matthews, if you are watching, you are this evening's lucky winner of the 2,000 Rands for our competition. Remember, you have to drop us a text before the end of the show to claim that 2,000 Rands cash prize. I know many people at home are counting on this rolling over and rolling over and rolling over. We're going to see if Megan Matthews is indeed watching us and will claim that prize. And I already see some of the love that we're getting on our Facebook page. Abeta, Albertine, Geraldine, Carlos, Queen Tako, as well as Unoninku Ta watching us on our Facebook page. Do keep that love coming up. And of course, I also want to find out from you at home as we're looking at structuring a property deal, and certainly looking at it from a beginner's perspective, some of the fundamentals that you need to be aware of, some of the mistakes you want to make sure that you watch out for, and how you can approach private investors and best positioning yourself for those private investors. And I find out from you at home if you've ever, structured a deal. How did you go about doing it? And what were some of the lessons that you learned even as you, tried to raise capital for your property venture? We've got on our Facebook page, one of our top fan gang members, Howard Muketsane, saying, please do structure your deal from negotiating the purchase, ensuring you're buying slightly below market, to negotiating your interest rates for as long as you get the lowest, and most importantly, do apply the registration for a higher bond. And I absolutely love that one, right, Grant? And we'll talk a little bit about that, especially for those who are looking at sort of single units, registering a higher bond. And in as much as when you access the money, you know that, let's say you register 1.5 and the bank also agrees that you can register 1.5, but you know that you've only asked for R1 million from the bank. And so you've got that, R500,000 buffer should you need it in the future. We'll talk a little bit about that. We've got Martha Shingang saying, I watch with admiration those who get into deals with big property developers, would be interested in knowing how that works. And Grant can speak a little bit about it. I mean, we've spoken to Grant about it when we looked at buying into a new development, firstly as at an individual basis, but also as an investor. How oftentimes you are able to make quite a good return when you get in very early with a developer, and the various ways that people are doing so. I think, Grant, let's start with Martha's one, because I think this is an easy, low hanging fruit. Getting into a deal with developers very early on. So more often than not, it's even before they break ground. How can people get a sense of which developer they can even approach to be able to get into that kind of relationship with them?
Yes, I mean, it's sort of, this is one of those contentious spaces where buying early into development, you get big returns, particularly phase one. The developers early on are trying to prove to the banks or their finances that they can sell the development, so they're very keen to get offers to purchase signed as quickly as possible and get guarantees in place. So you can, if you're going to go into developments where, and my first suggestion here is look at developers with a proven track record. I mean, it's vitally important, either proven track record or management team with a proven track record. It's almost when you're investing into development, you're actually investing into the development company when you're getting in early, because there's no actual assets underpinning your purchase. So look at the development team, understand their background, do search on social media, and the internet's an amazing thing. You can find a lot of detail about people these days, particularly where they've done things with shortcuts. So I would check out the development company. There are some big guys at the moment that are charging a premium. I'm not going to name any ones that I shouldn't, but there are guys that maybe you shouldn't look at. But be careful when you go into developments. There are issues around buying into large developments where there's a tenant focus. My suggestion is look at ones where there's a much higher percentage of owner occupiers. Those are generally better looked after and gain better capital value in the medium term. And just again, look at the existing demand around those areas. Particularly areas that are booming at the moment, you don't necessarily want to buy into the larger development because your competition is going to be immense over the next sort of 5 to 7 years.
And when we look at Howard's, point around registering that higher bond, I think this is one of those strategies that a lot of newbies and even people who've been doing this a little bit tend to not know upfront. The ability to register that higher bond. Just take us through how somebody at home would use that strategy and the benefit of using that strategy, especially when it comes to unlocking some capital, a few years down the line.
Yeah, so essentially, I mean, it's a cost-saving method and sort of just simplifies the process for you to access capital that you've created within your property. So using your numbers, you register a 1.5 million rand bond against a purchase of a property. You only need a R1 million bond from the bank, and you'll be paying your repayments on that million basis. But if you then want to access at a later stage, the 500,000 rand, you can do that quite easily without getting that second set of attorneys involved. The transferring attorneys, and you approach the bank to then access that. They'll generally send out a valuer to just ensure that their money is protected, but you won't have to register an additional bond element or a secondary bond against that property, which sometimes the banks don't like doing. So it's a much easier way just to access finance of a property, particularly if you've bought a property under value. It's a really good strategy to create future finance opportunity. And again, probably the cheapest form of finance that you'll get is bond finance.
I think, if anything, it's probably such a great time, especially right now, where the cost of that credit facility is so low. If you know that even when interest rates go up, which we know that they're going to go up, you're able to find a really great property and really push down that purchase price as low as possible. And the value you're still going to get away with, being able to register that higher bond just based on, the value of that property. It's probably a really great way to secure your ability to access that, capital at a later stage. Now, Grant, I think one of the big things is then for viewers at home who are looking to not only go the bank route or perhaps not even go the bank route at all. So if you're looking at targeting your private financiers, particularly those, because I'm seeing this quite a bit, those who've got the capital, they're looking at financing a deal and, would sometimes say, let's say in the next 2 or 3 years, these are the kinds of returns that I'm looking to have. How can you then at home sort of best position that deal for people who have the funds to be able to finance that deal, especially when you're not going to be using, any aspect of the bank's financing?
Yes, I mean, the first thing and the easiest access is the bank of mom and dad. Those are the people who should trust you the most. Who should give you the most access to financing. But ultimately, no matter who it is, whether it's your parents or friends or family or sort of colleagues, there's two elements to any investor. And what they want is they want returns on their money. And part two is security or de-risking their money. So they understand what the risk is and what the security underpinning that asset is. So whenever you're going to put a proposal together, those are really the things you need to address is what returns you can provide them on their funding, considering the deal in place, and then how do you de-risk that investment? So how do they know they're not going to lose their money? Now, the easy thing in property is that any finance is underpinned by a property, which is sort of a big advantage here, and why generally even financing from a bank is provided at a much lower rate than, for example, credit cards or loans, because there is asset backed, so that's useful. But what you need to do is then figure out, which some of you mentioned earlier, how do you get that investor's money back to them? So if you're looking to do a flip deal, it's a much easier sort of conversation to have. I'm looking to get into the property and other property within a year. But if it's a longer term holding strategy, you're going to have to be quite clear on how you pay that money back, whether it's a refinancing process in over a period of time, or whether you may be going to pay them back on a repayment basis during that period or for over a longer term. But generally speaking, you're going to approach investors that are looking to do 2 to 3 years. Very rarely, I think, you're going to get somebody that's willing to park their money with you for 10 years. And then you'd need to have an exit strategy and be very clear on how you're going to get their money back to them.
And I think, Grant, when you look at exit strategy, I want us to look a little bit on some of the people I know are looking at potentially financing people's deals. I mean, I get approached with this, quite a lot. Some people say, look, I've been approached and I've got a bit of money lying around. How can I best assess whether this is a good deal or not? And almost a question around, I think, beyond the good deal is how can I also make sure that I'm able to exit. Then for a financier, so your private financier, you may have some money a bit, and you have the friends or the family reaching out to back their property deal. How do you also sort of best make sure that you're able to firstly understand, have a very clear exit strategy? Because I think one of the key things that a lot of people seem to struggle with, both from the person raising that capital, but sometimes also for newbies who are, looking at financing people's projects, is having a very clear exit strategy. So there isn't a clear path of, okay, I'm getting in with, $500,000. I want to be in for X period of time. What would exiting look like for me? And if I exit at different stages of this deal, what are some of the returns that I'm looking at? I found that tends to be lacking, especially for sort of newbie players within the property space. So how can then on I'll say the investor side, where you're the financier, how can you almost have a clear view of your exit strategy? Because I think see-through is such an important thing that I think not a lot of us are able to have a good sense of.
Yes, I mean, again, it's about understanding the strategy that the investor is going into. So why are they buying the property? What's the purpose? What's the term hold that they're going to hold? It also comes down to then the agreement. So my recommendation is there always needs to be at least 2 exit strategies out of any deal. And that's for the investor, that's for the sort of private investor, but that's also for the property investor buying the deal. If you're going to buy a property for a flip and the deal doesn't work, you need to be able to either rent it out, put it into multi-let, subdivide, do something, develop it. There's got to be some other exit strategy. And in the same vein, the private investor needs to have more than one exit strategy, whether that means a sale of the property to come out of the deal, other financing that comes from somebody else that can replace your finance, refinancing with the banks. There's got to be multiple options for that exit in the timelines. Part two is you need to work on best case scenario and worst case scenario. So assume that going into, for example, a flip deal, you're going to get your money back with your returns in 6 months, but also maybe make the assumption that within a 5-year period, you might sit getting a monthly return and cater for that. You shouldn't really be investing private money with a property investor that you're going to need in 18 months' time. That money needs to be sitting somewhere, it's parked, and you need to understand that if you park it into a property, bricks and mortar is notoriously illiquid, particularly if the market turns against you, which you have no control over. So it's important that you do have multiple exits and multiple scenarios sort of catered for. And that's not only in the conversations that you're having, but also in the agreement that you put in place between yourselves. And I think this is one, if we talk about big mistakes that people make when they invest in property and particularly private finances, is not having a very clear agreement in place, and also not having the legal means to go and enforce those agreements when they're done. So my suggestion is certainly getting an attorney involved to make sure that your interests are protected, and that's both parties, not just the private investor.
And, Grant, I think one of the really big things, and I want to echo to viewers at home, especially right now, as we're seeing a lot of people increasingly getting excited about investing in property and being able to see different opportunities in their respective communities and filling different gaps, is that you still want the services of a professional. Always get an attorney involved the moment monies are going to be transferred. It's not enough to say, Uzamantongwa, you see her live every single evening. And so even when you're dealing with somebody who is, we'll say relatively known, or them from somebody, adequately doing your due diligence, and of course, getting an attorney involved in any property deal becomes such an important part, because ultimately it's monies that are getting involved. You're not just buying a pair of jeans, so you want to make sure that those basics are covered. Now, I was saying to viewers at home that I will share a little bit about some of my own mistakes, I think, that I made very early on in my property journey when it comes to structuring a deal. And it's something that Grant had actually highlighted, and that's being too optimistic. I think more often than not, when we look at the numbers, you kind of have the high end of what the returns could potentially be. And I think earlier on in my own journey, I used to run the numbers more on the optimistic side, and wasn't factoring vacancy rates, and kind of assumed that I would get sort of the maximum for the respective properties, as opposed to being slightly more prudent on the income that I was expecting or projecting for the property, and buffering in maintenance. I think I learned very early on, having made this mistake early on, that rather overestimate what you'll potentially spend on maintenance and budget that in. And obviously the aim is not to reach that target, than to underestimate your maintenance budget and then increasingly exceed it. I think those for me were the two things that I typically didn't look at. And some of the earlier properties initially would need work, and so also underestimating the costs of doing refurbishments, which is partly why I've become really great at running numbers when it comes to refurbishments. I think the last time we were even talking with Grant was saying how I'm a stickler for tiles. I know what tiles cost. I know how much cement costs, because I buy tiles and cement that regularly, and there's just certain items that one would need in a property that I buy fairly regularly, and have a good understanding of what that cost is. So rather overestimate those as much as possible, and factor them into your deal and factor them into running your numbers, than be prudent in them. If anything, if you want to be prudent on the income side. I think you're more likely to be more successful if you do it that way. I see more of the love that we're getting on our Facebook page. Sirifi Mwasheng saying Megan had an extra time to make a claim. Fulufelo Hope saying I really need it. Of course, referring to that 2,000 Rand cash prize that is up for grabs. And we see that Megan Matthews unfortunately has not claimed the money. She's got a few more minutes to potentially claim it. I want to wrap up with you though, Grant, this evening. When we're looking at the newbie property investor right now, what final tip would you give to them when it comes to structuring their property deal that they always need to bear in mind, even as we'll cover intermediate and more advanced levels of structuring a deal in future episodes? But certainly one of those common threads that are crucial regardless of which level you're in.
Yes, I mean, structuring such a broad subject. So we only had half an hour, and it's we can speak hours about this. So I think the most important thing for me is when you get into this property space, we're talking big numbers. Even the smallest property in South Africa, you're talking 400, 500,000 Rand. Very few people can afford to lose that sort of money. So I maybe just want to highlight the importance of professionals in the process. I think professionals at every level. There are very good bond originators. There are very good people that are invested in finance. There are very good attorneys that do structuring, and we talk about property deals that do installment sale agreements and standard agreements and private finance agreements and company loan agreements, all those sorts of things. So I think it's vitally important that at every stage you don't look at the cost of these people, because they're actually ultimately protecting you and saving you from losing a lot of money in the property space. We're not talking, again, 1,000 or 2,000 Rand here. We're talking a lot of money. So the big thing for me in newbies that I see is that they try and do things via Google or Facebook Warriors, take suggestions or Facebook groups and that sort of thing, versus addressing and speaking to professionals that they are paying for their advice, that have got a proven track record and expertise in this space.
Okay. And I think that's actually just such a great note to leave it in, Grant, that you want to work with professionals, because ultimately what you're going to spend when it comes to property is probably going to be the most expensive thing that you'll ever spend on. As Grant was saying, even the lower end property in South Africa is 400, even up to 500,000. The majority of South Africans don't even make that per annum. So you really do want to make sure that from the get-go, you're working with professionals and you're not cutting corners, because there's a way that cutting corners, especially in the beginning part, catches up with you in ways that ends up costing you quite a lot of money later on. So rather be clear from the get-go, particularly when you're structuring a deal. I think don't skimp on the professional services. It's very easy for us to think we can find a friend who can do it, but you really do want to work with people who do this for a living, and this is what they ultimately do to be able to help you structure your deal. Grant, it's always such a pleasure to have a conversation with you on the show. Thank you so much for joining us.
Thank you.
And that is Grant Smee, who's a director at Only Realty Group, wrapping up the Tuesday edition of the Private Property Podcast with myself, Uzamantungwa Khumalo. Unfortunately, I can see Megan Matthews has not claimed that 2,000 Rands cash prize that is in the money bag. And so we are going to have a rollover tomorrow evening. A part of me is interested to see how far we're going to have this rollover for. I think it would be quite interesting if you get to 10,000 Rands. I know many of you at home are watching with bated breath how far we are going to go. Well, we'll see who tomorrow evening's winner is. Remember, continue engaging with that post on our Facebook page. It's the pinned post where we're looking at having 20,000 comments on that post. And that is how we wrap it up this evening on the Private Property Podcast with myself, Uzamantungwa Khumalo. I'll be back on your screens tomorrow evening at 7 p.m. You can look forward to Mbali Nwoko bringing you the Farming Podcast at 8 p.m. Until then, hoping you're staying home and staying safe. you.